Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have Christian Munafo. He's CIO of Liberty Street Advisors and portfolio manager at Private Shares Fund. Tim Hoag, founder of Legion VC and general partner at Artisanal Ventures, and Scott Voss, managing director and senior market strategist at HarbourVest Partners. We're here to discuss the unique dynamics of growth and building phases in different stages of a company's life cycle and what signals IPO readiness. It is great to have all of you with us. Welcome to Trade Talk. Certainly a great time to have this conversation as the IPO markets are starting to heat up again. Christian, let's start off with the unique dynamics when you're thinking about growing and building versus pre-IPO. Just give some high-level thoughts around that.
Yeah, well, I think from our perspective, we always level set, and you look at the area we focus on, which is more later stage, growth-oriented companies. And if you look at the operating metrics of these companies, they actually rival a lot of what you'd see in the small mid-cap growth space of listed markets. So for us, the starting point is look at the operating metrics of what you see in the market caps in small mid-cap growth. And it actually is quite similar, if not even less than what you'll see in today's late-stage private innovation companies. There's actually more private market cap companies valued north of $1 billion today than there are billion-dollar market caps in the Russell 2000, which is something not many people realize. But from a growth perspective, you're looking for durable business models, right, that can weather different cycles, right, strong growth rates, margin, right, profiles that are sustainable. You obviously want to see that there's value propositions to the clients, so strong kind of deliverable value going to the clients, strong product market fits, which I know we're going to define today. And also you want to see that they're capital efficient. So it's not growth at all costs. We need to see that companies are on a path to profitability if they have not already achieved that.
And Tim, from the earlier stage perspective, what are some of the attributes that you're looking for?
I mean, if you look at the two ends of the spectrum, is the earlier you are, the more is more value subscribed to what is possible, and then the later you are, the more value subscribed to what is. And so when you look at kind of early stage companies is, hey, is this a team that you really believe can build to eventually an IPO company? Have they built and scaled this product before on someone else's dime? Because I think there's a million ways to do something wrong, and there's only a few ways to do something right. So if they've tested and iterated and figured out like the ideal vision and what they're going to execute, and then can hire a really compelling team around that, that's what we look for. And then number two is the industrial logic behind why this product is a high need product, why it'll be differentiated, and what's sustainable about it, to eventually get to Christian's phase where you can develop those repeatable, consistent motions to have efficient growth and have that predictable story on a glide path.
Scott, when you think about this reset from growth at all costs to more fundamental approach, do you think that reset needed to happen to a certain extent?
I do. I think it goes back to proving out that you have a long-term viable business model as a either publicly traded company or late-stage growth private company. I do think in the venture space as a private company, there is a part of your life cycle earlier on where it is grow at all costs. You're probably defining an industry that's an emerging industry, and you want to be the category leader in that industry, so you want to invest in growth and market dominance. But at some point, you need to transition your business more towards a line of sight to profitability. And I think that's true in the private markets and the public markets. We're here talking about venture, but one of the feature deals in the private equity space, the leveraged buyout space, has been take privates of leading mid-market publicly traded technology companies who have to transition their business model from grow at all costs to line of sight to profitability. The best way to do that is out of the sights of the public markets where you're managing to the quarter. You're probably managing a business plan over a couple of years, and partnering with private equity is a good strategy when you need to do that.
When you think about the VC space in earlier stage companies, it seems as if technology is moving so quick right now, right? Do ideas become obsolete, or are there too many solutions out there without a problem to solve?
No, I disagree. So I think a couple different things. I think because of the catalyst of AI, the problems that can be addressable is pretty much any problem. When you take a step back, the ones with the lowest hanging fruit are highly repeatable, typically service oriented, logic based, and so it might be support. So support tickets comes in, here are the typical 5 questions that you might answer, here's the reference docs that we want to provide, and you can provide theoretically a faster solution and a better outcome solution. Within legal, it might be various different briefs that are coming in that are fairly consistent motions. Accounting, you have journal entries on different items, and then you change your ledger, and then eventually you close at the end of the month, and then you update your financial statements. They're highly repeatable motions that a system can learn pretty quickly, that you're addressing not only now software spend, which is typically 3 to 5% of a company's revenues, but services spend, so their headcount, which is typically 50% of revenues. And then also full stack companies that are automating a lot of their human labor on the back end as they're becoming more and more automated. So I actually think there's going to be many more problems that are going to be addressed because of this inflection of AI. And yes, there are more companies in any given space, but the breakout companies, like we have companies in our portfolio, 3 of them actually went from 10 to 50 million ARR last year, which is largely unheard of pre ChatGPT being released. We have a company went from 3 to 30 million ARR, going to 300 this year. So the growth rates, I think, are justifying a lot of the prices that are being paid. And I think the outcomes have never been bigger before.
Christian, it's interesting. It makes you wonder, we've asked this question in the public markets, if ChatGPT did not become part of our vernacular in November 2022, just how different the landscape would look in public and private markets.
Yeah, I mean, it's been a game changer, right? I mean, we think back to transformational cycles like the internet, right, 30-ish years ago, and the effects that have. I think the one thing that we're cautious of is being careful about valuation froth, right? And business models that have not yet been tested for the long haul. So we've seen definitely some companies that have run pretty fast. We also think we need to be thoughtful and cautious. We've been more of a, I would say, infrastructure investor. Hard tech is kind of the new software. I mean, hard tech is enabling all these models, the advanced manufacturing, semiconductors, right? Everything that's going on with the space economy, right? Whether it be launch, infrastructure, orbital data centers. So from our perspective, we've been investing in AI for the last 10 years, I would say more from a infrastructure perspective, the pipes and rails that a lot of these disruptive software-enabled businesses need to run on. But ultimately, we think they're a more defensive way to play it. But I think, to your point, Tim, we're definitely seeing significant signals that it may be time to start spending more focus on some of the more software-enabled, kind of ChatGPT, if you will, businesses that are being quite disruptive.
And if I connect the obsolescence question with the ChatGPT moment, I mean, I've said this on other platforms, one of the conversations we have in our IC is, one, how do we give our investors access to this massive innovation cycle called AI? But what does it mean for business models that are relevant today but may be obsolete tomorrow? And then if you look what's happening in the technology landscape, from the largest cap, tech companies in the world, all the way down to the new innovative startups, there's already a consolidation that's happening. And it's companies trying to figure out how they maintain leadership and relevance in a rapidly changing world of AI. And in some cases, it's buying startup for AI enablement. In other cases, it's 2 one-time, long-time competitors actually forming partnerships because it's strategic for them to maintain their leadership position as some of the largest tech companies in the world.
Right. It's probably also a cost saver rather than having to grow these products and services organically when the technology already exists. And of course, the smaller companies have the ability to be more nimble than, let's say, a large company making a massive shift.
And on that point, I think there's the classic innovator's dilemma where if you have an existing customer base and you're delivering a certain product, like, yes, you can iterate and tweak and hopefully develop AI products on the back end, but a lot of times it might be a consumption model or you're lowering prices and you're cannibalizing your existing business. I think a lot of these next gen players that were formed post ChatGPT can put AI native in their tech stack. And then 2, they're not burning boats that they previously had because they had nothing. And so they're almost growing from 0 upwards. And I think those are pretty interesting companies because they can come up with much more disruptive models and basically address a prior company at 50% of the cost, 30% of the cost of what it might have been before, but to them, it's all net new growth too.
Yeah, I mean, Christian, getting acquired is not a bad thing either. You don't necessarily have to, IPO.
No, we joke 8 days a week, I'll take a cash M&A deal over the volatility that comes with a listed stock, of which you're locked up as a private investor typically for 6 months. Yeah, I mean, when we think historically, M&A is accounted for roughly 2/3 of venture-backed exits. The dynamic is the last 15, 20 years, as these companies continue staying private longer and are scaling into much larger market caps, when you're at $50+ billion, it becomes harder to facilitate M&A just constructively, but also from a regulatory standpoint, which is again why the secondary markets, continue to be an interesting interim solution to what may become an ultimately listed company. Or frankly, we've been saying it for years, and it's been, I think, received provocatively by clients that you're going to have the first $1 trillion private market cap company. Well, we're pretty close. We're probably 12, 18 months away from having potentially multiple $1 trillion market cap companies. And if you think about why historically companies go public, oversimplifying this in the interest of time, one is access of capital. The growth of private capital markets can solve for a lot of that growth today. Liquidity. Secondary markets can increasingly provide liquidity solutions to investors, employees, shareholders. And then currency, consolidation. There's a lot of well sought after private stocks today that are being used for private to private deals that are more appealing to some sellers of companies than public stocks. So a lot of the evolution of this public to private market shift is actually also facilitating the desire to stay private longer. But yes, we're happy to take M&A cash deals when they come.
Yeah, well, it's a challenge for the retail investor though, because you want exposure to these companies, which is, one of the reasons to go public if you're looking to, increase your investor base and provide that access. So I guess the question is, what's the optimal timing if you're going to IPO, or if you want to?
Yeah. So first, just on the retail investor, there is increasing demand for the retail investor to gain access to some of these great private market stories. And the reality is, there's 40% less publicly traded companies today than there were 15 years ago. And that's either because what I talked about before, where companies are choosing to go private, or there's fewer companies actually going public. They're just choosing to stay private. And the metrics that are interesting to me is if you looked at the successful venture-backed IPOs that happened in 2024, the sweet spot tended to be to go out at a $5 to $10 billion valuation. And we've seen the public market investor benefit from that. Some of those companies are now trading at $20 or $25 billion market cap. So the public market investor has made a return. In 2025, we see that number creeping up. It's 10 to 20 billion. And again, the public market investor is having a benefit. But we've talked a little bit about some of these companies that are valued at 50, 100, 400 or 500 billion, and they're privately traded, and they may never go public. And those companies are defining their industry. Those companies are what the retail investor wants access to. So there's new channels and new marketplaces that are facilitating that opportunity for the retail investor.
And I think there is like a high demand from that retail investor, to your point, like to put numbers on it, companies growing above 25%, in which in the private markets, above 400, 500 million ARR, there's dozens of them. And on average, they're getting valued at like about, high teens multiples ARR. And so there is this large public demand and kind of honestly starvation to get access to a lot of these companies. It's just, I think when companies feel that they have that predictable revenue, consistent management team, consistent board, strong product market fit story, but then also about 4+ quarters that are in the bag in which they think they'll beat and raise, and then have also prepared and practiced being a public company and practiced having calls when then they were a private company, having the CFO, the correct audits, correct regulatory. We're seeing a lot of companies that are hiring those CFOs and hiring those teams in preparation of being public, because I think once you become public, the bar goes up, but it increases the kind of what is necessary for your organization to deliver, and I think you're going to get stronger organizational performance in the public markets.
Do you think that's being public ready with the option to go public, or it's being public ready with the intention to go public, or both?
That's a good question.
I mean, it's at least the option, because we are seeing lots of CFOs being hired for a lot of our private companies. You don't prepare unless there is some part of you that wants to. And so I think there's lots of companies that do want to be public, especially when you see the recent performance of some of these recent IPOs, and how within one day they've traded up 100%, 200%. Obviously, they're rare cases, but I think it does show that with the right metrics, 130% or 120% net retention, growing 50% plus, potentially profitable today, if not profitable over the next 12 months. Like, those strong companies are getting lots of investor demand that I think they would want to reap some of the benefits in the public markets.
Yeah, and the hygiene I think we see in our portfolio, I think along those lines, is we're seeing companies trying to measure how effective their forecasting ability is. Because once you become a listed company, right, if you miss your quarterly earnings by a penny, you can get crushed.
Right.
So I think it's assembling the right team, it's assembling the right auditors, assembling the right governance, and making sure you have the processes, procedures, and controls in place, right, to not shoot yourself in the foot when you go out for your earnings. But again, some of these companies, I guess to what we're saying is, they still may just opt to stay private longer. I mean, OpenAI is, just to name one company, their last financing round was $40 billion. That's larger than any IPO raised that we're aware of on record. So the ability for these companies just to continue raising privately, we frankly see no sign of that stopping.
Yeah, at a $500 billion valuation, which
Correct.
makes them a top 20
Correct.
company by enterprise value, regardless of
Regardless.
whether they're private. Right.
Exactly.
Yeah, I mean, you could also make the argument too, it depends what sector you're in as it relates to being regulatory ready as well. You know, tech versus, let's call it, you know, a medical device company. Those are two very different sets of regulations and compliance that you need to be aware of.
Yes, 100%. But I think it goes back to kind of, there's a certain amount of regulatory bar, whatever industry you are. So compliance or or healthcare financial services, pick your industry, that might be overly scrutinous, and tech, general software might be less. But there's still new teams that you need to have. There's still new procedures that you need to have in order to be ready to become public. Teams are doing that today.
Yeah, so, okay, let's talk about the pipeline for a moment then as we wrap up in the next 4 minutes here. How do you feel about it going to the back half of the year in 2026? Is it tech specifically, or are there other sectors that you're seeing enter the fray more dominantly?
Well, I mean, it's hard to say. I mean, tech touches just about
everything right
today. I mean, if you look very strictly at what went public year to date, there's been a little over a couple of dozen tech IPOs that you can clearly define as tech IPOs, which is, versus an average of 4 the last 3 years. So it's a low bar, but we're definitely seeing things pick up. We're definitely seeing a lot of engagement with the capital markets across our portfolios, and so a lot of companies we're seeing engage to pursue an IPO. We think that'll continue. SPACs, whether we like it or not, are back on the rise. Nowhere near levels we saw in 2021, but they are actively forming and also looking for ways to facilitate some of this kind of public, foray. From our perspective, we absolutely do expect to see things pick up over the next couple of quarters into next year. Some of the regulatory bottlenecks we've seen kind of get loosened up, both for, I think, listings and also M&A. But the reality is, look, you wake up any given morning not knowing exactly what you're going to expect. And we saw, obviously, over the weekend, we saw some developments with regards to the tariff situation. And so I think it's going to continue to be, a volatile path, but we're definitely seeing a lot of optimism around the IPO window over the coming quarters.
Yeah, and if you think about it with, AI and all of the emerging technologies that are available today, it's only going to broaden out the sectors that are coming public as well. I mean, it touches industrial, energy, utilities, you could even argue.
Yeah, absolutely. I'm very optimistic about kind of the pipeline of companies that are teed up, and we need more certainty, so we're not surprised by the news. But I think, I talked about the profile of the companies that went public last year and this year. I think we're poised to see a company go public at a $50 or $100 billion valuation, and that will be a bit of the unlock, I think, for just more and more IPOs, for companies to see that path and that opportunity and choose to take the public path.
I think it's a good point, because I think the amount of risk was probably higher. You haven't seen IPOs for quite some time, and there were a couple that I won't name that obviously recently, ServiceTitan, Rubrik, Figma, who went public, who had good, strong debuts, and then other companies looking at them and saying, okay, that is what the appetite is.
Yeah.
To your point, maybe the next risk curve is, okay, with increasing size, that $50 to $100 billion range is an additional risk curve, but it's not nearly as much as just going public in general. So it's less of a need to believe. I think you will get hopefully dozens of companies going public next year because of the strong path that some of these more recent companies have had. And they're putting in a lot of the work right now for it.
All right, and we'll leave it on a positive note. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.